Hello and welcome to my channel. Today, I'm going to be talking about employee stock purchasing plans, or ESPPs, and considerations to make before contributing money towards one. Alrighty, let's start with some definitions. An ESPP, also called ASPP, or Associate Stock Purchase Plan, is a benefit that allows employees to purchase their company's stock at a discount. The funds used to purchase the shares are usually deducted directly from your paycheck. Now that we have the basic definition of ESPP out the way, let's go over what it is not. Investing in the stock market through your employer can take shape in a lot of different ways. It can be RSUs, equity, or 401k contributions. However, not all companies provide the opportunity to invest through any or all of the means I mentioned. In any case, ESPP is another benefit and it's distinct from all of these kinds of investments. Like a lot of people, my first exposure to the stock market was through my 401k. Where I worked at the time also offered an ESPP. So after about 6 months on the job, I signed up for that. Before I go any further, I do want to stress that I can only speak to my experiences, so you'll definitely want to check with your HR benefits team or a CPA to make sure you're fully informed before making any financial decisions. I know other companies may structure their ESPP benefit differently than what I've actually been exposed to. I've heard of many places where there's a 6 month offering period for company stock, and you can purchase shares at the cheaper cost basis between the date when the offering period began and the cost of the stock on the date when it ended. That's a lot more lucrative than my employer's benefit was structured. In any case, let's talk pros and cons, in my opinion, and how things worked for me at a high level. The first and most obvious advantage of participating in ESPP is the discount. This is at the core of how the benefit is designed. I was allowed to contribute up to 15% of my annual salary towards it. Whatever amount I ultimately contributed would receive a 15% match from my employer. So if I made $1,000 each month and contributed 10% or $100, then my employer would contribute $15 towards the stock purchase for a combined total of $115. If I contribute the maximum 15% throughout the year, with my employer's 15% contribution, that would have raised my compensation annually by over 2%. A second advantage is the fact that you work there. There's some nuance to this that we'll discuss in a couple minutes, but hear me out for now. Warren Buffett has famously said, "Never invest in a business you cannot understand." This is really good advice and explains a lot of the reason why I haven't started investing in cryptocurrency yet. All right, I digress. But yeah, I know it can be tempting to chase things like SPACs and other hypergrowth stocks, but it is important to do your due diligence when investing. And when you choose to invest in a company that you work for, this is probably a bit easier because you have exposure to the product or service your company offers, and you have context for the current challenges, future outlook, competitors, and a bunch of other things that are important to think about when deciding on whether or not to invest in a company. When I worked at my old company, leaders there would often summarize and discuss sentiments from the earnings calls, short-term priorities, and things of that nature during all hands meetings. All of this helped me to further contextualize the investment I was making and feel more comfortable. ESPPs are a great way to learn about investing in the stock market. You have the opportunity to see an individual stock rise and fall and then rise again over time. I guess this depends on the company though, because there are some that haven't risen back. In any case, investing through my ESPP was a great way for me to grow my risk tolerance and overall understanding of how the market works. This was a key reason why, when the value of my portfolio dropped significantly last March, both within my ESPP shares and then just kind of broadly, I didn't panic and sell everything because I did have the confidence that, hey, this is going to rebound. Another advantage is dollar cost averaging. Dollar cost averaging, or DCA, is an investment strategy that aims to reduce the impact of volatility on a large financial purchase by dividing up the total amount to be invested across periodic purchases within that target asset. All right, so again, in English, an example would be like, let's say you know that you have $12,000 that you want to invest in a stock or ETF or whatever throughout the course of a year, right? So your goal for 2021 is, hey, I want to invest $12,000 in Apple, for example. Let's say you invested $12,000 a couple weeks ago, right? And then now all of a sudden, the value of those shares have dropped significantly. While in the long run, things will probably rebound. That can kind of be painful to see right now, right? What I just described, first of all, is lump sum investing, right? So what dollar cost averaging instead does is you know that you want to invest $12,000 during 2021. So instead of investing it all at once, in January you'll put 1,000, in February 1,000, and so on and so forth. That way you kind of achieve your target investment amount, but it's varied throughout the course of the year where you're getting it at different price points. So yeah, kind of controlling for volatility and minimizing the potential negative impact for large drops in the stock price. Though M1 Finance has an automatic investing feature for individual stocks, and Robinhood recently introduced a similar recurring investing option, most brokerage firms don't yet support that level of automated investing into individual stocks. ESPP is one of the few ways that you can automatically buy individual stocks on a monthly basis, and this pays off. According to a Forbes article, a lot of individuals who were using ESPP to invest, in their company stock saw huge gains once the prices of the stock rebounded because they were still buying in the dip. Now, this sounds all fine and dandy, but what are the disadvantages? Well, it's funny you asked. The first potential disadvantage is the brokerage firm that the shares are purchased through. When you're investing by yourself, you get to choose the brokerage firm that you want to work with. However, when you're purchasing shares via an ESPP, you have to go with whatever firm your company uses. The company I previously worked at used E-Trade, and I was charged $15 per trade for my ESPP shares. As commissions industry-wide decreased, the commissions with E-Trade eventually fell as well. However, though buying or selling stock as a regular E-Trade brokerage customer is free, for my ESPP shares, the commission is still $6.95 per trade. Another thing to think about is just like, how do you like this company, right? Some brokerage firms could have poor customer service, platform stability issues, or many other concerns. Be sure to research the brokerage your company uses beforehand, since this may factor into your decision making. Even if your company eventually switches their ESPP provider, at least you'll initially know what you're signing up for. The second potential disadvantage is the fact that you're taxed. At my old company, the ESPP employer contribution was a taxable benefit. Any gains I made from the sale of the stock were also taxable. Though a 15% discounted stock was tantalizing at the time, I would have been much better served by maxing out my tax advantage accounts like my Roth 401k and Roth IRA before investing using the employee stock purchasing plan. The next potential disadvantage is the element of risk. If you're seeking to capitalize on the 15% employer contribution in the short term, be sure to weigh the risk against the reward. Fluctuations in stock pricing throughout the year can undermine the discount you're getting. In saying this, I'm reminded of another Buffett quote where he said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." If you work at a so-called fair company and the stock price drops enough, you may see significantly less than a 15% ROI when you account for the taxes you paid on the employer contribution, in addition to any commissions assessed for buying or selling the stock from the brokerage. This can be exacerbated if you have a specified minimum holding period for your shares. Remember, I'm speaking to how my company's specific ESPP benefit worked as I understood it. Other benefit configurations may have a different level of risk. This really depends on your goals and your personal risk tolerance, and also your time horizon. And then we have the last and most important disadvantage to consider, and that's the financial reliance on your employer. For most people, the majority of the money they have comes from their full-time job. While you may have a side hustle or an emergency fund, if you were to lose your job, your finances would probably be tighter than usual. And when you take your wages from your 9 to 5, full-time job and invest it back with your employer via stock, you leave yourself further exposed to the employer. financially. So let's say your employer enters financial turmoil, and on top of being fired, the stock price is now impacted. So now you're doubly hit because your investments and your income have both been significantly decreased. Instead, if you still want to take advantage of the company match for the employee stock purchase program, consider selling the shares as soon as you can. I could have sold my shares as soon as they settled, which would usually take about 2 business days, since I didn't have a holding period. From a diversification perspective, I also would have been better served using those funds to buy an exchange traded fund like VTI that invest in thousands of companies across different industries instead of having most of my portfolio concentrated with a single stock. This is it. I hope you enjoyed this video. Let me know in the comment section if you're using ESPP or what your thoughts are on it. Thanks.